The unemployment rate is spiking across America. More and more people are getting laid off from their jobs, and this is suggesting that the economy has entered a tipping point, that the rapid downturn that many of you've been waiting for out there is happening right now. With the unemployment rate in America spiking from a low of 3.4% in early 2023 all the way up to 4.1% today. This increase in unemployment rate is very similar to what we saw happen back in 2007, 2008 before the last big crash, as well as in the early 2000s before the dot-com bubble burst. Now, most of the people in charge of the economy are still saying that the labor market is healthy and that the US economy is strong, whether it be Jerome Powell testifying in front of the Senate or our President Joe Biden bragging about how many jobs he's created. However, what matters most is the short-term movements in the number of unemployed people in America. And we have recently crossed a threshold in terms of the growth in unemployment that means that there's no going back. That means that we are now on the tracks towards a recession where the unemployment rate is going to continue to increase and likely to see home prices go down, likely to see stock prices go down due to passing this threshold. And the threshold that I'm referring to here, folks, is the year-over-year growth rate in the number of unemployed people in America. You can see that through June 2024, the number of unemployed people in America grew from 6 million last year to 6.8 million this year. That's an 800,000 increase, or a 14% year-over-year increase in the growth in unemployed. And so that's a really key indicator to understand. That's not the unemployment rate that we're looking at there. We're simply looking at the number of people who are reporting to the Bureau of Labor Statistics that they can't find work and that they're looking for work. And so when you see a 14% year-over-year increase in just the raw number of people who can't find a job, historically that means that the recession is coming. Because you can see, if we draw a dotted line across this 14% increase threshold, we can see that every other time the number of unemployed people has increased by this amount, it has been directly preceding a big recession, a spike in the number of unemployed people just in the next 6 months. Every time, without fail, this threshold being breached has led to a big recession. And to be clear, we're still in the early phases of this, everyone, right? So the growth in unemployed is 14% year over year. If we go back to 07, 08, you can see we were at a similar point in time in late 2007. December 2007, unemployed growth was 13% year over year. That was the signal back in late 07 that there was big problems coming on the horizon. A lot of people didn't pay attention to this back then, and then over the next 6 months, everything became clear. And so for you guys out there as home buyers or investors or just someone wanting to understand the economy, this is an important inflection point. We are truly seeing the labor market slow and slow fast. Many of the layoffs that have occurred over the last 1 to 2 years are now finally starting to show up in the government job numbers. I'm sure a lot of you have long suspected that the economy was on unstable footing and that the number of unemployed people will go up. Well, it's happening right now. And I got to tell you folks, this is coming as no surprise to me. Because not only have I looked at the data for the last 2 years on where the economy is heading and kind of knew that it was heading in this direction, but I've also spent a lot of time traveling around America, meeting locals, meeting you guys out there in different cities and different states. I was just in Florida for 3 weeks. And I was shocked at the amount of people I met in Florida who were struggling, who maybe had just lost their job and were trying to find another job or just trying to do various side hustles to get by. I was just in California a month and a half ago. It was the same story. I was shocked at the amount of people I was meeting who were vocally telling me that they were struggling economically and financially. And so this is really no surprise that we're finally seeing it in the government jobs data. But I think what's really important is what comes next, right? Because if we go back to this graph, right, we can see that once we hit that 13-14% unemployment growth year over year in the number of unemployed, like pretty soon after that, the number of unemployed people tends to skyrocket. And we have all the different recessions here, folks. The recession of 1958-59. We have the recession of the early 60s. We have the 1970 recession. We have the 1973 recession. We have the double dip recession in the early 80s. We have the Gulf War recession in the early 90s. We have the dot-com bubble in the early 2000s. We have the massive financial collapse in 08-09, and then we have COVID, of course. And so you can see that in every single one of these cases, there was a lead up, there was kind of a momentum occurring in terms of how many people were reporting that they couldn't find work. And eventually that momentum spilled over into a gigantic crash where all of a sudden unemployment skyrocketed. And we got to ask the question, what's going to happen to the economy and to the housing market and to the stock market if unemployment starts to really go up in a vertical line? Like if this increase from 3.4% unemployment rate to 4.1%, if that continues over the next 6 months and we see a 4.5% unemployment rate, a 5% unemployment rate, that'll be the signal that it's on and that we're likely to see more job losses in the future. We're likely to see an actual recession, right? The one that a lot of people have been calling for the last 2 years. And if that actual recession materializes, there's a strong chance that both the housing market and stock market crash, right? I mean, the stock market right now is just at a record bubble, actually keeps going up. It keeps setting new highs, even though the fundamental indicators in the economy keep saying that things are getting worse. So we have a massive disconnect between stock market asset valuations and the real economy. And it's getting bigger and bigger and bigger. Eventually, that gulf is not going to be able to sustain itself. Eventually, people's losing their jobs and being pinched by inflation, it's going to cause them to spend less money. And when they spend less money, it's going to mean lower earnings for publicly traded companies. And when they have lower earnings, their stock valuations will go down. In terms of the housing market, more unemployment, more job losses, less consumer spending. Obviously, that's going to mean fewer home buyers, right? People are not going to feel good about their financial situation. They're not going to feel good that they can hold their job. So they're going to be less likely to want to buy a house. And that home buyer demand, everyone, it's already at rock bottom levels. With investing.com reporting that mortgage applications to buy a house are down at an index level of around 142.9. You can see that mortgage application index of people applying for mortgages to buy a house, it's down 50% from the pandemic peak, and it's down about 40% from pre-pandemic levels. So we are still in the basement in terms of home buyer demand. So important that you remember that if you're someone tracking the housing market. Buyer demand is literally the lowest it's been in decades. That's an indisputable fact. Mortgage purchase applications and existing home sales, they're in the tank. Ask any realtor out there, if they're honest, they're going to tell you that the buyer demand is really, really low. And so if we already have really, really low buyer demand, well, then you pile on an increase in unemployment on top of that, and you get a situation which could mean extended years of low housing demand intersecting with a big increase in supply. Because that's the other thing that increased unemployment will likely drive onto the housing market, is more people being forced to sell their homes. If someone loses their job, often they'll be forced to sell their house if they can't find a new job soon enough, or if their savings aren't high enough. Additionally, if one of these amateur real estate investors loses their primary job, there's a good chance they're going to look to liquidate some of their investment properties. So don't be surprised if new listings and inventory on the housing market continue to increase as unemployment increases. And we're actually in an interesting inventory environment right now on the housing market, everyone. Pay attention to this graph. You can see Realtor.com just released their June inventory data, and we have 840,000 listings on the U.S. housing market in June 2024. That's up 37% from where it was a year ago. It's almost double the low that occurred during the pandemic in June 2021. It's basically back to the June 2020 inventory levels, and slowly but surely, we are getting back to pre-pandemic inventory on the housing market. We're not quite there yet. We're still about 25% down on inventory compared to 2019 levels. However, we're climbing, and we're climbing fast. In addition, sellers are cutting the price now on these listings at the highest rate that we have seen since 2018. So we have rising inventory to go along with rising price cuts, a signal that things are getting better for you as a buyer on the housing market. But now, here's an interesting variable to throw into the situation. Now that the economy is clearly slowing, right? I think most people are going to admit that. when they look at the data at this point. The people who said like, oh, there's not going to be any recession or economic downturn, they're starting to put their heads in the sand a little bit because the data is becoming more and more clear that the economy is slowing. So what are we going to see the Federal Reserve do in response? Jerome Powell, he just testified in front of the Senate today, and he gave kind of like his typical wishy-washy, saying a lot but really saying nothing kind of answers to questions. On one hand, he said that there's a danger in cutting interest rates too early because it could reignite inflation, but then he also said there's a danger in waiting too long to cut rates because it could make the economic downturn worse. What's the Fed gonna do in response to this slowing economy, this increasing unemployment issue that we're now facing in the economy? Well, I think eventually the Fed's going to cut rates, everyone. I mean, the Fed always cuts rates at some point in the economic cycle. When it becomes clear enough that there's an economic downturn, the Fed cuts rates. And right now, the betting markets are predicting that we're going to see 2 rate cuts by the end of the year, which, if that were to happen, it would bring short-term Fed funds down from around 5.4% to 4.9%, and it would probably bring mortgage rates down from around 7 to 6.5, right, if the Fed cuts rates twice. And so, there's a lot of people out there in the housing market especially, they think that as soon as the Fed cuts rates, that the market's going to boom again. They think that as soon as mortgage rates just go down by a little bit, all these buyers are going to come back in. However, that's probably not going to happen, everyone. Like I showed you before, the buyer demand is literally the lowest it's been in 20 or 30 years. Mortgage rates going to 6.5 is not really going to change that. The affordability equation is really, really bad right now, and it's going to take huge declines in both prices and mortgage rates to bring buyers back. But I think what I actually really want you to focus on, folks, is what a Fed rate cut means for the economy at large. Because this is something that is really interesting. I pulled some historical data here showing what a Fed rate cut means for the future of the economy, and actually for timing, actually, in particular. What I did for you folks here is I looked at data from the last 9 recessions here, and I ordered them 1 to 9 here, the last 9 recessions, and we looked at the date that the Fed initially cut interest rates prior to or during the recession here. You have the date that the Fed initially cut rates. And on this column, I put the unemployment rate at the time of the cut. So you can see on average, the unemployment rate was 4.9% when the Fed cut rates initially in these recession cycles. The next column is showing you what the trough unemployment rate was, what the lowest unemployment rate was prior to that cut. So on average, the lowest unemployment rate was 4.3. It increased to 4.9. And that caused the Fed to cut rates. So on average, all the unemployment rate had to increase was 0.6%, and that caused the Fed to cut rates. That's a really important thing to understand, everyone, is that the Fed historically cuts rates early. Like in the last 9 recessions, going back to the 1950s, the Fed cuts rates kind of early before you really see massive job losses. The Fed never waits for massive job losses to start cutting rates. And I think there's some people out there who think that. They think that like the Fed typically will wait until there's a crazy recession to cut. That's not what happens. In fact, in the last 4 recessions, going back to the Gulf War recession in 89-90, you can see the Fed didn't wait at all, actually, really, for the unemployment rate to go up. You can see the unemployment rate only went up 0.2 to 0.1% or didn't go up at all. And so the reason this is important, everyone, is we could see we've already seen a pretty big increase in the unemployment rate from 3.4 to 4.1%, a 0.7% increase, and the Fed has yet to cut, which now has some people concerned that the Fed is going to be late in their rate cut here in 2024. The betting markets say September will be the first rate cut. That's another 3 months potentially of issues in the labor market that could play out. And so I think it's an important framework for you to understand. The Fed has already kind of waited a long time, at least based on the historical precedent of when the Fed cuts. And so that suggests that the lag effect inherent in the interest rate hike cycle and the economic downturn, it suggests it could be pretty big, and that even if the Fed cuts rates in September and December twice this year, that's not going to necessarily have a material impact on the economy. Like the wheels could already just well be in motion on the economic downturn, and the Fed cutting is going to be too little too late. That's how it typically works, everyone. It typically works that way. The notion that people have developed that the Fed cuts and the economy is saved, that is not what typically happens. That's what happened during the pandemic. And then the government printed all that money, but that's not the standard course of action. Standard course of action is unemployment gains grow to a certain level, the momentum in increases in unemployment rate gets to a certain level, 13, 14% growth year over year, that at a certain point, the recession becomes unstoppable, and the Fed cutting rates a couple, basis points here and there isn't really going to make a material difference. Of course, everyone, we're still kind of early here. Right now in June 2024, it looks a lot like it did like in early 08. It looks a lot like it did in the early to mid 2000s. So there's still going to be a lot that needs to happen over the next 6 months for my predictions in this video to come true. We'll need to see that continued softening in the labor market, that continued increase in the number of people reporting to the BLS that they're unemployed. But if we do, that will be, the message. That will be the signal that this recession is on. And so make sure to pay attention to those government job figures. I know a lot of you are skeptical of them, but historically, it's a pretty big data set over the last 70 years. And, there's a pretty consistent trend to when the unemployment rate increases enough, when the number of unemployed people goes up enough, you pass the threshold, the tipping point of no return. Could we be there right now? The data is starting to suggest so. And so if you're someone who wants to stay on top of the trends in the economy and housing market, make sure to hit the subscribe button, turn your notifications on. I'm going to be doing 2 of these videos a week over the next 3 to 6 months so you guys can stay on top of what's happening. Additionally, this is the first video I've done kind of behind a computer screen in probably the last 2 or 3 months. I've been on the road almost nonstop over the last 2 months, so it feels good to get behind the camera. Let me know what you thought of this video in the comment section below, and also leave some requests for some other topics you want me to cover. Until next time, this is Nick from Reventure signing off.